from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the race to space. We look ahead to Jeff Bezos' flight crew, including the 18-year-old student who will now fly with the world's richest man. Plus, Netflix marking its first big move beyond TV shows and movies by betting big on gaming. More on the company's decision to tap a former EA and Facebook executive to lead that charge. And former head of Google Ventures Bill Maris is putting $1 billion to work at the intersection of technology and life sciences, where he sees the biggest problems that need solving as we emerge from the pandemic, and how he's putting his money to work at Fund Section 32. All of that in a moment, but first, let's take a look at the markets with our own Kriti Gupta. Kriti, what are you tracking today?
Well, Emily, a risk-off day in the markets. You really saw it in the stock market because the two sides, two extremes of that recovery trade. Your very economically sensitive small-cap stocks, then, of course, your big tech growth stocks, both in the red today, and that's really where you're starting to see that large breadth of selling, really taking the S&P 500 down, with it down 0.3%. Where's the money going? Right into treasuries, those yields dropping about 4 basis points. But that is not the trend that you've seen this month, Emily. Very much an intraday basis, because this month you've seen that actually diverge. You've seen growth, outperformance, those economically sensitive bets, those small caps that were rallying so much after Joe Biden's election, after that Pfizer vaccine announcement back in November. This month, not doing so well. And really, you're starting to see that divergence signaling, well, there is a little bit of a safety trade here. Now, why? What is the driver between this? And this is really where I want to point to the 10-year yield, because it is actually playing a role in the stock market. That's that white line in the middle. And you can really see it's the yellow line. You can really see that the Russell 2000 and the NASDAQ are both moving in tandem, just as the 10-year yield is as well. So as you see the yield dip, it really starts to impact the selling that you see in those two indexes, Emily.
All right, Kriti, thanks so much for the roundup. Meantime, Jeff Bezos' Blue Origin has picked an 18-year-old student to fly to space with the Amazon founder and 2 others next week on the company's first crewed mission. Blue Origin saying Oliver Damon will be the youngest person to fly to space if all goes to plan. Blue Origin saying the anonymous bidder who agreed to pay $28 million for the seat has a scheduling conflict and will fly later. I want to bring in Bloomberg Tech Senior Executive Editor of Global Tech Coverage, Brad Stone, for more. So, Brad, everybody knew the date was July 20th. That is what this bidder bid on. What happened here?
Boy, Emily, there's very little about this billionaire race to space that has been normal over the past few months. I mean, first you had Bezos announcing he was going to go first on New Shepard, despite the fact that Blue Origin employs 2 NASA astronauts on the payroll. Then Richard Branson kind of beating him to suborbital space last week. And so maybe it's not unusual that things once again are kind of screwy. But right, they held an auction for that 4th seat on the New Shepard. They're blasting off on Tuesday. Somebody paid $28 million to go to space with the world's richest guy. And now they're saying that he has a scheduling conflict. It doesn't really add up, but the bottom line is that it's moved to kind of the second highest bidder. That is this 18-year-old, or at least his family. And now he's going to make history in a way by being the youngest person to go to space.
Right. So as I understand it, this boy, this 18-year-old's father, actually was bidding for that seat that ultimately went for $28 million. And Blue Origin says he chose his son to fly in his stead. Oliver Damon, I understand he's planning to study physics in college next year in the Netherlands. Who is he?
Boy, I mean, I think you've essentially said everything we know about his biography. His father is a prominent Dutch private equity investor. And, they didn't even think that they were kind of in the running. And here they are, the second runner up. And he's having his big moment in the sun, or at least in suborbital space next Tuesday.
And, looking at this Oliver's Instagram account, he's a kid. It'll certainly be interesting with Jeff Bezos, Mark Bezos, his brother, Wally Funk, who will become the oldest person ever to go to space, all of them on board together. I mean, what do you make of the fact that Richard Branson had a successful launch over the weekend, Jeff Bezos thought, I believe, he was going to be the first of the billionaires to fly on their own craft to space. But he'll be second, though I'm sure, again, last but not least, right? What are your expectations for the event?
Well, I mean, first of all, I don't think Bezos really viewed it as a race with Branson. I mean, he picked July 20th because it's the 52nd anniversary of the Apollo 11 moon landing. And it wasn't to beat anyone out of the gate. And Wally Funk was a member of the Mercury 13, these female astronauts that didn't get to fly. So she fulfills a lifelong goal. And now with Oliver, it's the youngest person to go to space. I mean, for Bezos, this is symbolic, right? He wants to reinvigorate interest in spacefaring, a sense of swashbuckling adventure. So I think this is more kind of a symbol. And it's also really a symbol of the remarkable trust he has in this company, Blue Origin, because he's really putting himself out there as a bit of a guinea pig. And no human being has ever flown on this thing. So it's really breathtaking in a way. And I think for Tuesday, seeing his smiling face popping out of the crew capsule, if and when it returns safely, I think is going to be an important moment for Blue Origin, for Bezos himself, and probably for people's interest in space travel.
Absolutely. Well, we're all hoping for a safe and successful launch, and we'll be talking about this, I'm guessing, every day until that happens. Bloomberg Tech's Brad Stone, thanks so much for your perspective there. Meantime, Netflix is making its first big move beyond television and movies, planning to expand into video games. Netflix has hired a former top exec at Electronic Arts and Facebook to lead the way. The goal? To add games to the streaming platform in the next year. Joining us now, Matthew Baugh, managing partner at Epillion and a former global head of strategy at Amazon Studios. Matt, great to have you back with us. So you predicted that Netflix would get into gaming years ago. How big can they be in this business?
Well, thanks for having me. I think the starting point is really to acknowledge how large they are today. They have 200 plus million subscriptions. They've said previously they have 3.5 accounts per subscription. That's over 700 million people, many of whom use the service on a monthly, if not weekly or daily basis. That makes it one of the most popular, most used media platforms globally. And that inevitably leads you to that question, what's next? What's more? And no one can launch a media experience today to more people than Netflix.
So how do you imagine this to roll out across Netflix? Will they be producing their own original games? Will they be licensing games? And how robust do you think the offerings will be?
It's a good question. I think the best way to think about this is just to take a look at the historical progression of Netflix. They said that they started their tests for streaming in the early 2000s. They launched in 2007. They developed the Netflix Originals brand in 2009, launched their first licensed show in 2011. And by 2017, 85% of new spending was for their originals. I expect a similar progression here. They will start likely with licensed titles, outsourcing most of the development, a substantial portion of the creative. But it's very clear based on what they've said that this is a long-term trend. And they will eventually move farther and farther and farther up the stack into more and more creative.
Now, your predictions have been good thus far. You've also said that Fortnite is Netflix's most threatening competitor. How so?
Well, there are two ways to think about that. Number one, Reed has always said that their competition is leisure time. They varyingly describe their greatest enemy, this is their own quote, as sleep. They have said that their competition includes not just books and podcasts, but having a glass of wine with your partner. This has become a very common way to describe competition in entertainment, but today there is no segment of the leisure market that media companies lose to more often than social gaming experiences. You cannot dominate leisure without having a meaningful offering in social gaming, in multiplayer online gaming.
So then what does that mean for Netflix, the traditional competitors that we think of when we think Netflix, like Disney, Disney Plus, and HBO?
This is a great example of trying to stay ahead of the market. They were years and years before the rest of the market into branded originals, into going into global competition, binging. Many of the things that now define the streaming wars, they solidified by about 2013. And as I mentioned, it's very clear that gaming is the next big thing. And Reed, Ted, and the rest of the company seem focused on what the company looks like in 2025 as the rest of the market tries to replicate what Netflix was in 2013.
All right. Well, Matthew, we're going to continue to follow your thoughts in your portfolio. I know you just had a company, GenVid Technologies, focused on interactive television, just raised some new funding, and Netflix veteran Cindy Holland joining the board there. So appreciate your insights here. Matthew Ball, Apillion, Managing Director, former Amazon Studios. Thanks so much for joining us. Another story we are watching, Taiwan Semiconductor is underscoring its crucial role in helping alleviate a global chip shortage. TSMC expects sales to rise more than 20% this year. The company makes chips for Apple and many of the world's largest car makers. Coming up, SPACs may have slowed down, but the blank check boom, not over. We hear from Khosla Ventures founder Vinod Khosla, whose firm is sponsoring multiple SPACs. Next, this is Bloomberg. The IPO market has never been hotter, and while SPACs have cooled off since the year's earlier surge, the blank check boom is not over. Warehouse automation company Berkshire Grey plans to list on the NASDAQ via SPAC later this month. Venture capital firm Khosla Ventures was an early investor in the robotics company, and founder Vinod Khosla joins us now. Vinod, great to have you back here on the show. You have sponsored multiple SPACs so far this year, and I'm so curious, given the many years you were a founder, of course, of Sun Microsystems and of Khosla, you've been an investor for a long time. What's the opportunity that you see in SPACs that's new?
Well, SPACs offer another opportunity and then another investment vehicle, just like an IPO is or private equity funding is. It's just a different vessel. If you look at the biotech industry, they've been able to do IPOs 5-10 years before first revenue. They need to project into the future, explain their future, and IPOs have been available to them. There's many more areas of technology that fit the same model. And for them, SPACs may be a great alternative. We announced Nextdoor recently as a SPAC. One of our SPACs did. Berkshire Grey is a great example of an opportunity where the future has to be explained. It's a strong technology company that has to be explained. And so SPACs play a large role in these kinds of opportunities.
So let's talk a little bit about Berkshire Grey, one of your longtime portfolio companies planning to SPAC. This is a warehouse robotics company that counts Target, FedEx, Walmart among its clients that basically helps to automate the supply chain. What do you think is so disruptive about their technology, and what does that disruption mean?
Well, we started with Berkshire when it was one founder alone. And the opportunity came from the following fact. Amazon is a serious technology company, has developed a lot of automation for itself. In a world where consumers are demanding immediate shipments and very low-cost delivery, every part of the supply chain, from e-commerce to retail fulfillment to grocery to third-party logistics, parcel sortation, they all have to be deeply automated. Amazon's doing it for themselves. The opportunity for Berkshire Grey is to do it for everybody else who can't keep up with Amazon on the technology and to get an integrated solution. Traditional supply chain suppliers really don't understand AI and robotics. They may call it AI, but it isn't AI. And then there's a lot of startups with niche solutions. Berkshire offers the only really complete solution that is next generation AI to compete with Amazon for those vendors under pressure from Amazon.
So basically, it sounds like you consider Berkshire a way for everyone else to compete with Amazon.
Absolutely. They have to. Their cost structure depends on this. Their delivery times depend on it, and that matters a lot to consumers. And so it is the alternative for everybody, for the technology that Amazon is developing inside. As you know, many years ago, they bought Kiva, a robotics company. They've done a lot of automation for themselves. Somebody will have a large opportunity in doing it for everybody else, whether it's the customers you mentioned, Walmart and Target, or others.
Now, when it comes to robots, there's always this question about robots taking jobs from humans, not necessarily filling jobs that need to be filled. And I wonder, has technology actually progressed to that point? And if that happens, is that a good or a bad thing?
Well, I think robots will switch the kinds of jobs that exist. One of the larger opportunities in all of industrial America is inverting the supply chain. A lot of manufacturing happens in China. That needs to be done locally in the US. And so there's a large opportunity here. I do think robots will do automation and increase e-commerce and, in fact, probably increase employment. There's a certain ratio of humans to robots that will generally be deployed.
Now, Vinod, you have become famous over the years for your sort of black swan thesis of investing that the best and biggest technologies, those are the ones to invest in, even if they have a high % chance of failure. But the key is not being afraid of that failure. As we emerge from a pandemic, what do you think are the black swan technologies of the post-pandemic era, given that the pandemic is something that certainly most people didn't see coming?
Well, in fact, pandemic has accelerated a lot of other opportunities. I think inverting the supply chain and strategically not being dependent on China is one major opportunity. There's opportunities in construction, there's opportunities in food, there's opportunities almost every area I look, whether it's insurance and fintech or healthcare. So technology-driven opportunities will be very large, and Berkshire Grey is a great example of completely renovating the supply chain to meet consumer demands for instant delivery of everything and at almost free cost to allow people to compete with Amazon Prime. That'd be just one opportunity, but broadly, it's part of this inverting the supply chain for local everything.
Okay. Now, as you mentioned earlier, you're also sponsoring a deal with Nextdoor. Obviously, Nextdoor has, we have needed our communities more than perhaps we ever did through the pandemic. It was our only touch point for months as people were under lockdown. Of course, Nextdoor, while it has great potential, has also been struggling with racism and hate, neighbors not helping neighbors. How do you think Netflix balances Nextdoor, balances those challenges going forward? And what do you see as the potential for Nextdoor?
Well, this is a problem with the online world, but Nextdoor has a very unique advantage because it's both online and offline in the neighborhood and community. And Sarah has been emphasizing the community aspects of it. It's much harder to be mean if you know the person you're talking to and see them face to face at the coffee shop or in a park picnic. And I think Nextdoor has this unique opportunity to add community and thoughtfulness because it's one of the only networks that has this online-offline connection. And to take advantage of large opportunities, we all talk about the sharing economy, but which online network is best equipped to share a pasta maker you might want to use 1 hour a month, or a lawnmower you might want to use 1 hour a week? So we can substantially enhance community, enhance communication, and the tone of the online and offline communities. I think Nextdoor has a large role to play. And Sarah, as you know, came from Square, where Sarah and I worked together for 7 years. That was a purpose-driven company, and Sarah has very much made Nextdoor a purpose-driven company, going after building community in a way that other online networks can't.
Sarah Friar, the CEO of Nextdoor. Vinod, I have only 30 seconds left, and I'm so curious what you think about whether Silicon Valley, as we know it, is sort of over now that so much so many more startups are distributed, people have left Silicon Valley because of the flexibility the pandemic allowed, or if you think people need to be here to produce amazing technology?
Well, Silicon Valley, more than anything, is a culture. It's a state of mind. And I think that culture, the more broadly it spreads, the better it will be. Having said that, I don't expect the importance of Silicon Valley to decline, but I do expect other regions to also grow up with this remote work. I think it's generally a good thing for the country and society in general.
All right, Vinod Khosla, founder of Khosla Ventures. Thanks so much for joining us, Vinod. Great to have you back here on the show. All right, coming up, Alexa, how about a new voice? After the break, we're going to find out who Amazon has secured to become the new voices of the personal assistant. This is Bloomberg. A few other stories we continue to watch. Facebook has seen a decline in female representation across its workforce. Women at the social network made up 36.7% of staff by the end of June. That's actually down 0.3%. This is the first time that number has dropped since the company started publishing data. Facebook says it's due to the social network's overall increase in technical roles, which is dwarfing recruitment for other types of jobs. England soccer star Bukayo Saka has criticized Twitter, Facebook, and Instagram for not doing enough to prevent the posting of racist messages on their platform. The 19-year-old player, along with two other teammates, started receiving racist abuse online after missing penalty shots in the World Cup final last weekend. Both Twitter and Facebook say they've been removing posts and disabling accounts since that game. And Amazon Alexa is getting a makeover. Starting today, you can replace the default voice with Shaquille O'Neal or Melissa McCarthy, for a price, of course. Once purchased, they can tell you the weather, read a poem, tell jokes, along with many other things. They follow in the footsteps of Samuel L. Jackson, whose voice was made available to Alexa users 2 years ago. Coming up, Indian hospitality startup Oyo took some tough hits through the pandemic and is now seeking $600 million in funding to refinance debt. CEO Ritesh Agarwal joins us next in an exclusive interview. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get another look at the markets with Bloomberg's Kriti Gupta. Kriti, what are you watching now?
Well, Emily, widespread selling in today's intraday trading, but I really want to highlight a divergence because you saw big tech really take the brunt of the hit today, but you are really seeing the other side of the world. Those Chinese tech ADRs, very tech-heavy index, actually in the green, up 1% on a day that was notably risk-off. And this, of course, coming as you see the SOX index dropping with that broader risk-off tone. But I really want to highlight, in addition to that divergence, when it comes to the SOX index, you are seeing a little bit of stagnation. Now, this is the start from the March bottom all the way to now. Look at that SOX rally. It has been a straight line up, a few corrections in the middle, but really just a straight line up. This idea that a global chip shortage is really going to keep that sector bolstered. But here's the problem. It's stagnating, Emily. And if you compare it to the NASDAQ 100 on a technical basis, you can really see the NASDAQ 100 breaking out, really a little bit of a kind of bullish pattern there. But on the SOX, it has been a straight line across. The question, though, Emily, is this going to be how the SOX index is going to be trading from here on out, or can those chips really catch up to the rest of the tech sector?
All right, Kriti, thanks so much for pointing that out. We'll keep watching. Well, touted as the Airbnb of India, Oyo is an online marketplace for small hotel owners and customers looking for affordable accommodation. Like most in the hospitality industry, the startup was hit hard by the pandemic, but it's starting to get to the other side and hopes demand will pick up by improving user experience through technology. Joining us now, Oyo's CEO, Ritesh Agarwal. Ritesh, great to have you with us. Look, there's no question the pandemic was tough for the travel industry. Brian Chesky, the CEO of Airbnb, told me it felt like being hit by a giant torpedo. How did it feel for you?
Oh, I think first off, thank you for having me here. But the feeling was close, if not exactly the same. It was, I'd probably say, a cyclone, given in our part of the world, there are quite a few cyclones. But hey, I think our company was growing triple-digit percentages for 2 years. And then our numbers dropped by 66% in gross margin, more than 66% in a period of 30 days. So it felt like we built something for 6-7 years, and it took 30 days for that to drop by 66%. So it took a little bit of time to get your head together, but at the same time, I think credit to our team. I think the crisis playbook is always the same. It's cash, cost, and innovation, and I think we really have pushed the lever on innovation quite a bit over the last year.
Meantime, obviously, vaccines are now available, but not to everyone. India itself has been struggling with variants of COVID-19. What sort of travel trends are you seeing now?
So I think, Emily, first off, I think around the world, there's a big transition that we're seeing is that anywhere where there is more than 40% first jab of vaccination, we have seen travel bookings rapidly accelerate. And that's the case around the world. We are lucky to see this in all the countries that we serve around the world. We are market leading in India, Southeast Asia, and Europe. So I can share trends for these markets more specifically. I think what we're seeing is in Europe, the European summer is looking very good. Even though there is a slight rise in cases, we are seeing that European travel is looking very strong. India went through a temporary challenge due to the wave 2 of the virus, but our transactions are back up to the pre-wave 2 levels, and we are seeing now slow but steady climb. And of course, US is ahead of pre-COVID levels. We had one of the best Memorial Day weekends earlier this month back. And of course, around the world, wherever vaccination rates reach 40% plus, you're seeing the trend. India is now at 20% plus in first jab rate, but India has been doing vaccinations of anywhere between 5 to 10 million people a day. So fingers crossed, and we'll hopefully have more vaccination rates in times to come. And we're innovating by trying to have vaccinate tags in hotels where the entire staff is vaccinated.
Now, as I understand it, you had to do some layoffs, you pulled out of some geographies, you changed your business model. Some of your partners, your hospitality partners, hotels, weren't happy with that. Where do the business fundamentals stand now, and where do those relationships stand now, given that's so critical to your business?
Absolutely, Emily. I think, like I mentioned earlier, COVID, frankly, while brought some pain, but also those challenges allowed us to innovate and make changes that were very critical to the company. So for instance, to begin with, we tried and invested in terms of making sure that we looked at what really works for our business, for our customers and our owners, and what are they happy about and what can we improve. We saw that our owners liked our 2 core softwares, our OS and OYO. We said, this is the only business we will run with our merchants. We will serve these softwares and charge a fee against it. And today, over 100,000 merchants use it. There were some feedbacks that we received from them on pricing, reconciliation, and various areas. I have personally, over the last year, been spending 70% of my time in product and engineering and just trying to make sure that we're constantly innovating and staying ahead of the game and bringing great product experiences. I run weekly town halls with our owners. Sorry, Emily, go ahead.
Well, I was going to ask about the finances, because this proposed issuance for $600 million, it was oversubscribed. You're looking to refinance existing debt. Many people think it looks like what sort of the moves Grab made before they SPAC'd, some of the moves Airbnb made before they go public. Is this a precursor to some sort of go public event?
So both the companies you mentioned, we are lucky to have them as our partners and shareholders, and have always been inspired by their progress over the last year. I think, Emily, of course, clearly we see this as a very critical point in our company's journey, because it is important for us from 3 things. The first is it widens our shareholder base beyond, of course, some fantastic shareholders. We have Sequoia, Lightspeed, SoftBank, Airbnb, Didi, Grab, all great investors. It brings a new set of capital providers around the company and widens the capital holders base. I think the second thing is that we are probably the first Indian company not just to raise a TLB, but also be able to get rated. So I think it sets the validation of a company that has been rated by Moody's, Fitch, and various well-known agencies. And the third is, the response we got is very, important validation of our, performance. We went to the market for 600 million. We got an order book of close to $1 billion. We have now allocated, we upsized the deal to $660 million. So we are announcing the raise of 660 instead of 600. And we also, of course, tightened the terms of the transaction. So it clearly is a very important milestone. But on the other hand, from a public company perspective, Emily, I think we have, for the recent couple of quarters, we've started operating like a public company with a board which is primarily independent and non-executive. Company issues guidances, delivers, and then issues a further forecasts. So really, we are already operating like a public company. When we go public is then, of course, up to the board.
So the company was, I believe, before the pandemic, valued in the area of $10 billion. Where's that at now?
I think, Emily, we'll leave that to the public investors to decide where the company is. My job is to put my heads down, serve our customers and merchants right.
Okay, I had to try. So give us the one-year outlook. 1 year, hopefully more people are vaccinated. Hopefully more travel is happening. What does that look like for Oyo?
So I think both for Oyo and the travel industry, Emily, I think things are never going back to what it was earlier. Our customers and merchants are actively transitioning. 70% plus of our merchants today, Emily, have never ever used any online source for getting demand. Now with Oyo, on an average, they receive 80 to 90% demand from online. That's changing. So we feel that the advent of online from a merchant perspective will be huge. And from the customer perspective, staycations, long-term vacations, holiday homes versus hotels. Big hotels will not be in vogue. Small holiday homes will be in vogue. And of course, value will be in the game. So I think a combination of these trends are what we are noticing coming up into the future. And, we are innovating and bringing the best features and announcing them consistently to make sure that we are leading the path rather than standing behind. And on the employee side, we are also making changes. As we saw people having substantial overwhelming periods in countries where the cases went up, we moved to 4 days work in places where it was needed. We're trying to make changes in terms of how we collaborate online. So I think fundamentally, the world is going to be a very different place, and we are hoping to lead some of the trends like staycation, small hotels, online, value, and things like those.
All right, Ritesh Agarwal, CEO of Oyo. I know it's a very early hour on your side of the world, so thank you so much for getting up to join us. Appreciate it.
Thank you.
Coming up, how technology can help prevent the next pandemic. We're going to hear from GV, formerly Google Ventures co-founder Bill Maris, about his fund's new investments. This is Bloomberg. COVID-19 underscored the need for innovation in biotech, healthcare, and more. Section 32 is a venture capital fund investing in technology and life-saving medicines. Bill Maris, who founded GV, formerly Google Ventures, left in 2016 to start this new firm, which has since raised 3 funds and now has $1 billion in assets under management. He started his own career in biotech studying neuroscience and is back with me now. Bill, good to have you back here on the show. Obviously, it's been a roller coaster of a year and a half, and certainly in your business. As we come out of the pandemic, where do you see the biggest problems that need solving, and how do you put your money to work to do that?
I don't think I've ever seen a more opportunity-rich environment as an investor than now. But that's because we face tremendous problems and challenges, and I think it stems from the fact that unwell people have always co-opted the tools of science and technology to do harm to others, whether it's setting fires or using a gun. But now those same people have access to tools and technology that literally create extinction level events. And I think we need to take that seriously. And there's a lot of opportunity to invest around it to address a major existential problem for humanity that I think is completely not understood or widely accepted.
So what do you mean when you say we face existential extinction level threats? That's obviously a very dramatic statement.
Let me give you an example. Canadian researchers recreated the horsepox virus using DNA and RNA sequences that they ordered through the mail, and for under $100,000, which was done years ago. That same experiment could be done for a lot less money and using technology that is readily available. A lot of it is available in high schools. And to build a nuclear weapon takes a lot of people, a lot of scientific expertise, and is very difficult from an engineering perspective. To engineer a perfect virus is a lot easier. And if we think that there aren't people that will be motivated to do that, we're sadly fooling ourselves. And I don't think we are any better prepared for the next pandemic than we were for this one, unfortunately. And the fact of the matter is that this was the most benign and benevolent pandemic that you could imagine. So a lot of people died unnecessarily, and a lot of money has been spent, and most of it not well, to be honest. But a less than 1% mortality rate, if you compare that to SARS at about 10%, MERS at about 30%, and H5N1 flu at about 60%. If any of those were to catch hold in the same way with the same R0 values as COVID has had, you're looking at, at 20% mortality, civilization shuts down. People don't go to work, the power grid shuts down, and we're in a lot of trouble. At 60%, I don't think that's necessarily recoverable from a humanity point of view. The world will be very different.
Okay. So that's obviously sounds terrifying, but, and maybe creating a virus is easier than building a nuclear weapon, but it's by no means easy, is it? I mean, it takes PhD level skills, resources that teenagers in high schools definitely don't have. And, maybe creating smallpox in a lab is one thing, but a deadly virus that could be used as a global bioweapon, isn't that something on a completely different scale? I
wish that were the case. 15 years ago, that would have been true. Now that's not true. It is not technically difficult, and mistakes happen, by the way. So my guess is that there's a very good chance that the next pandemic, by the way, stems from something humans have done, whether intentionally or something escapes a lab, than something nature puts forward. There's a very good chance of that, and whether it's by mistake, there are many.
Bill, if that's the case, then why is it so hard to find patient zero, for example?
For with regard to COVID, well, in that case, I think that there's not clarity, let's say, on where this virus stemmed from, whether it came from a lab. There are many examples of level 5 biosecurity labs having leaks and accidents, or maybe something intentional. Or did it come from nature? But I think the Chinese government has been far less than cooperative or forthcoming about the origins of what we faced.
Okay. So, given that this is your thesis, this is sort of where you're coming from, where do you see the next frontier of opportunities for investment in terms of putting your money to work to solve what you believe, are these big threats?
Yeah, and doesn't sound like it, but I am an optimist, which is why I do what I do. And I think that if we make a serious and sustained effort to invest in defenses for these evolving threats, to paraphrase Rob Reed, that we stand a great chance of preventing or blunting the effects of the next pandemic. There are detection, diagnostics, antivirals, antibodies, vaccines, new diagnostics. There are a lot of ways to tackle what we face, and I'm optimistic that we can do it, and we should do it. Will we actually do it? That will take more than just me. That takes a will of humanity and society to really invest in detection, response and containment, treatment, vaccine development. And I am not seeing outside of the world that I exist in a global interest in those things, unfortunately.
Now,
to answer
4
your
years
question,
ago, you said the sun.
Sorry, I was just going to say, to answer your question.
Okay. Let me ask my question,
Yeah,
and then
go ahead.
and then I think your answer will also apply to this question. You said 4 years ago that the sun is setting on the golden age of Silicon Valley. Where is the sun now?
Yeah, I think I was right about that. I think the sun has set in large part, and by that I mean the disruptive, fun, quirky companies that were challenging the established dynasties and monopolies are now seen in large part or portrayed as the kind of evil empires sucking up people's capital and private information and so forth. So that at least the public perception of that has really turned, and those companies that were up and comers are now the dominant incumbents who are eventually will be disrupted themselves.
So then let's talk about where the money goes, right? Like, you're obviously looking for companies that have a chance against the giants of today. Where are those opportunities?
Yeah, I think if you look at the top 5 or 10 largest companies today versus the 5 or 10 largest companies 15 years ago, 20 years ago, you'll see a pretty stark difference. There are a lot of companies like HP and Compaq and DEC and those who are seen as leaders. There's a lot of turnover in technology when it comes to leadership, and the cycles are fast enough that there will be a company that disrupts Google and Facebook and Amazon. It's just a matter of when and where they come from, and they're likely not big companies aren't not likely to disrupt themselves. And so I'm always looking for, on the technology side, the companies and the entrepreneurs who really have a vision to use their brains and technology as a lever to hopefully improve upon where we stand, whether it's from a healthcare perspective or from a technological perspective. Because frankly, we are in, I'm going to paraphrase David Sachs here, we are in a race between the acceleration of technological advancement in the world and the deterioration of our political and social systems. And I have not just faith, but a deep belief that technology can help us to address those problems. But it doesn't look great sometimes. And I think we need to kind of accelerate the pace of our investment in some of these areas.
All right, Bill Maris. Well, whenever you come on the show, we know it's going to be a provocative conversation. Thanks so much for giving us your view of the world and how you're turning that into investments. Thank you so much, Bill Maris, Section 32. All right, coming up, another tech company calls for FTC Chair Lina Khan to be recused from an antitrust case leveled against it. We'll find out why next. Plus, as we head to break, Jack Dorsey has taken to Twitter to announce his other company, Square, is creating a business line to help developers build financial products focused on Bitcoin. He said the sole goal is to make it easy to create non-custodial, permissionless, and decentralized financial services. The name? Yet to be determined. This is Bloomberg.
I love capitalism, but I always believe that you need to put some guards around it when it comes to ensuring capitalism works.
Senator Amy Klobuchar there talking to us about the need to ensure a level playing field in the world of technology. That is part of my conversation with her for our special show, Red Lines, where we take a deep dive into the renewed calls for the regulation of big tech. We also look at some of the big players, including the new FTC chair, Lina Khan, who's been a longtime critic of big tech companies. Just this week, Facebook called for Khan to be recused from participating in decisions about the agency's monopoly lawsuit against the social network, given their concerns of her bias. Amazon previously made a similar request. So who is Lina Khan? Why are these companies so concerned? Let's take a look.
At just 32 years old, Lina Khan took the helm of the FTC, setting the stage for a showdown between Washington and Silicon Valley. Khan is one of the most outspoken critics of big tech, which she says has gotten too big and should face tough questions about its power and impact on democracy. Before the FTC, she served as a Columbia Law Antitrust Associate Professor and an advisor to the House Judiciary Subcommittee taking on antitrust issues. Khan is perhaps best known for her award-winning article titled Amazon's Antitrust Paradox, calling for greater scrutiny on the e-commerce giant. All eyes are now on how she puts her views of big tech's so-called monopolistic practices to work.
You can catch up on our special show, Red Lines, U.S. and Big Tech, on Bloomberg Television throughout the weekend, starting 7 p.m. Friday, Wall Street time, 4 p.m. right here on the West Coast. You don't want to miss it. If you have had trouble following all of these cases going back and forth, this is your way to understand what's going on. That does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. Join us tomorrow. We'll be joined by Max Levchin, founder and CEO of a firm, and George Kurtz.